G'day, thanks for tuning into this week's video. Today we're going to be touching on the topic of life insurance and what can be done in the event your insurance policies become too expensive. Over time as we age, generally most policies will increase in costs each year we get older. Now, we understand the importance of having these policies in force, which can protect our financial situations in the event of death or becoming total and permanently disabled, through to suffering a trauma event and even income protection. So they're the policies we deal with in our office. Now, a lot of clients, or we've had clients in the past come in and say, okay, this policy is becoming expensive, what can be done? So I thought I'd share this information on with those watching this video today. Now, if it is becoming too expensive, really question, is the policy necessary? Should I have it in force? Before cancelling it, get your advisor to do their review on the policy itself. Your advisor can re-quote the policy to see if there's cheaper alternatives out there on the market. They can sit down with you and discuss, the amount of cover you've got in force. You may be overinsured. So, for example, if you reduce your benefit levels, most likely you'll reduce the cost as well. When your initial policy was set up, what was the reason it was set up for? Was it to, provide a lump sum that was enough to eliminate debt? Since the policy was established, your debt levels may have come down a bit. So for that reason, your level of insurance should come down as well. So, we always suggest to have, our clients' policies reviewed every 3 to 5 years, for example. So reducing benefit levels will help reduce the cost of cover itself. You can also change the features of policies. So we'll bring income protection in as an example here. An income protection benefit will cover a percentage of your income. You'll also have to choose a waiting period and a benefit period. So if you increase a waiting period, you will be able to reduce the cost of a policy. And also if you decrease your benefit period, so how long you receive those benefits for, the policy will become cheaper once again. So those are a few things we can tweak in that space. Lastly, superannuation. So superannuation could be a great tool to cover the costs of insurance policies. So you can own life, TPD and income protection insurance within superannuation. So if you're currently owning those policies in your own name where premiums are being funded from your personal cash accounts, you can perhaps apply for a new policy that is owned by superannuation. So instead of your own cash flow covering the cost, it's just drawing on your superannuation benefits. So there's definitely pros and cons with that strategy, such as the drawdown of your super to cover the cost of premiums. But if it means freeing up some cash flow, you may decide to go down that path. So you've certainly got options. So if you're going to take a message out of this video, you've got options before you cancel policies, and it's always important to speak with your financial planner just to discuss what options you actually have. Thanks for watching the video.